Welcome back to your ultimate pit stop, Piston Pundit. In early 2025, US-Canada relations didn't just cool, they seized up like an engine run dry. What began as tariff threats and political chest-thumping escalated into something far more disruptive. A consumer-driven market backlash that ripped through supply chains. When Canadian provinces pulled US spirits from shelves and shoppers embraced Buy Canadian, the impact exposed how fragile even long-standing trade relationships can be. The immediate headline centers on bourbon, but beneath that is a larger mechanical failure, one that matters to anyone tracking manufacturing, logistics, and vehicles. Here's how this story really unfolds. From trusted ally to consumer revolt, Canada pushes back. For decades, Canada functioned as the smoothest lane in America's trade highway. Predictable demand, minimal friction, and a deeply synchronized supply chain. Then, 2025 introduced political torque nobody had modeled properly. Annexation rhetoric and tariff escalation didn't register as negotiating tactics north of the border. They landed as an identity shock. When Canada was repeatedly framed as a 51st state, consumers responded faster than any government ever could. By early spring, provinces began pulling American liquor from shelves, and everyday shoppers reframed purchasing decisions as a form of economic protest. That shift matters because markets don't just respond to price, they respond to trust. Canada isn't a fringe customer. It's the United States' largest export destination, and more than 30 US states rely on Canadian demand as a structural support beam. Once that beam cracked, the system destabilized. And here's the dangerous part. Consumer behavior doesn't reset automatically. New buying habits, substitute brands, and local-first routines tend to persist. Canada didn't fire a retaliatory tariff barrage. It simply reprogrammed demand. In trade terms, that's not noise. That's a system recalibration. And when demand gets reprogrammed, the first place the damage shows up is where inventory can't move fast enough. Kentucky's bourbon reckoning, production pauses, and financial stress. Now we move into the damage zone, where the long-cycle nature of bourbon production turns demand shocks into financial emergencies. Bourbon isn't assembled on demand, it's engineered years in advance. Distillers commit capital early, filling barrels that must age, absorbing storage costs, taxes, and carrying risk long before revenue materializes. When exports to Canada reportedly collapsed by roughly 85% in Q2 2025, that aging inventory didn't vanish, it piled up. That's why Jim Beam's decision to halt production at its Claremont, Kentucky facility for 2026 matters far beyond one brand. Bottling and tourism continue, but pausing distillation signals defensive positioning even among industry giants. This isn't trimming excess. It's protecting the balance sheet under uncertainty fueled by trade disruption and weakening consumption trends. Layer in broader shifts, like historically low alcohol consumption rates and the stress compounds. Smaller players feel it first. Ohio-based A.M. Scott Distilleries Chapter 11 filing is one example of how quickly temporary slowdown becomes restructuring. In mechanical terms, this is a system overloaded by inventory inertia, demand collapse, and tightening financial tolerances, exactly how shutdowns go mainstream. And before we zoom out to the wider industrial consequences, take a second to support the channel. Before we delve deeper, do us a favor and smash that like and subscribe button. This helps us reach more auto enthusiasts just like you. Now let's shift gears, because this story doesn't stop at bourbon. Why bourbon's collapse shakes autos and industry. This is where the story shifts lanes into territory every vehicle watcher should care about. The bourbon collapse isn't an isolated failure. It's a live demonstration of how integrated North American trade systems behave under political friction. Canada isn't just a buyer of finished goods. It's a critical node in logistics, manufacturing flow, and just-in-time production models that autos depend on. When cross-border trade slows, transportation volumes soften, warehouses back up, and scheduling precision erodes. For automakers, that instability translates into higher buffer inventories, alternative sourcing costs, and delayed production planning. Think of it like drivetrain vibration. The noise starts in one component, but the entire system feels it. Tariff uncertainty also ripples into material inputs, steel, aluminum, packaging, and agricultural feedstocks like corn, which ties rural economies to industrial output. When throughput slows, overtime disappears, supplier contracts tighten, and local spending cools. Whether it's distilling or assembling vehicles, unpredictability becomes an invisible tax. And once instability takes hold, countries don't just react, they reposition. Canada's strategic turn: buy Canadian Reshapes markets. Canada didn't simply boycott US products, it recalibrated its market behavior, and that recalibration is where exporters quietly lose ground. The Buy Canadian movement evolved from rhetoric into reality, reshaping shelf space, bar menus, and default purchasing habits. Even after retaliatory tariffs were lifted, several provinces kept American spirits sidelined, reinforcing a critical truth: consumer behavior often outlasts government policy. Once domestic producers gained breathing room, they expanded into it. Canadian distillers benefited from patriotic momentum, improved visibility, and a cultural push toward local alternatives. What began as a temporary disruption quickly resembled a permanent rebalancing. Politically, this shift aligned with broader changes in 2025, as voters rewarded leaders who emphasized sovereignty, diversification, and resilience. For automotive enthusiasts, the parallels are unmistakable. We've watched supply chains reroute under risk pressure before. Once investment and loyalty shift, they rarely snap back overnight. Trust, not tariffs, ultimately decides where production, capital, and future programs land. Which brings us to the core risk hiding underneath all of this. The real risk and only fix: trust under strain. The most serious threat exposed here isn't the boycott itself. It's the erosion of automatic trust in U.S. economic reliability. When buyers normalize substitutes, the United States stops being the default supplier. And once that happens, it loses the benefit of the doubt when conditions tighten. In the automotive world, that matters enormously. Automakers commit billions based on long-term confidence in policy stability and cross-border coordination. If North America begins to feel politically volatile, investment naturally drifts toward regions that appear calmer or offer broader access with fewer surprises. The solution isn't flashy, but it's essential: stability. Canada doesn't need to win. It needs confidence that rules won't change with every political flare-up. That means consistent trade enforcement, reduced rhetorical escalation, and renewed coordination in sectors like energy, manufacturing, and critical materials. If volatility persists, Bourbon won't be the last warning. The same cycle: tariffs, backlash, substitution, and investment drift can easily spread into autos, parts, and industrial inputs. And that brings us to the final dashboard warning. Verdict: the Bourbon crash is a warning light for North America's entire engine. If this story were a dashboard, the Bourbon collapse wouldn't be the failure. It would be the warning light finally illuminating a deeper problem. Step by step, we watched how political rhetoric triggered consumer backlash, how export cliffs became inventory pressure, and how Canada's pivot began to outlast any single tariff rollback. The verdict is straightforward. In a tightly integrated North American economy, trust functions like torque. Once it drops, the entire system loses pull. The twist is that this outcome isn't locked in. The United States can still stabilize the engine, but only by treating predictability as strength instead of weakness, and coordination as a competitive advantage rather than a concession. In manufacturing, autos included, stability attracts capital just as reliably as incentives do. Now let me ask you, if Canada can reroute Bourbon this fast, which industry feels the next squeeze? Autos, agriculture, or something bigger? How much should consumer sentiment factor into trade and manufacturing strategy? Can North America rebuild trust without rewriting its entire economic playbook? Share your thoughts and experiences in the comments below. Before you go, subscribe to Piston Pundit to get notified about the next vehicle updates and upcoming videos. Thanks for watching, and check out the videos on your screen. There's plenty more to explore.